Very, very important, discipline and confirmation. Now, if the markets are really strong, we expect all the stocks or maximum stocks to do better. Calculations can be done. This tenet lays the foundation of intermarket analysis also. It provides clear guidelines for the trend. We have seen more indices can be created. Prediction is not our work. Prediction is done in astrology, not in stock markets. I do not agree with this. It is applicable on every market. You will be out of the market in just 1 or 2 years. Hello, good evening, good afternoon, everyone. This is Bharat Jhunjhunwala and I am a CMT, CFT, MFTA, MSTA, and probably I have tried to cover everything that is relevant to technical analysis academically. Anyways, in the last session, we have discussed the Dow theory. We were discussing the Dow theory and we have discussed the first 3 tenets of the Dow theory. We discussed the introductory part and everything else. Now, in this episode, we will discuss the next 3 tenets of the Dow theory, and then we will cover the pros and cons, and then finally we will conclude. And you can download the MCQ questions from our website. The link is in the description. You can go there and click the description and you can get the MCQ questions that will help you in probably a better preparation for your examinations. So with that, let us start, and please do let us know about the quality of the content and what do you want us to include, and if you really feel that this content is helping you in preparation or revision, do share it with your friends who are also pursuing CMT Level 1. So we will bring up everything relevant to Level 2, Level 3 as we move forward. So let's start with the 4th tenet. Now, 4th tenet is a very, very important tenet, and now this tenet lays the foundation of intermarket analysis also. So we will read later on in your curriculum about intermarket analysis, and we will read the works of John Murphy in it. But the base of intermarket analysis, the concept of intermarket analysis was derived from Dow theory. Now, what Dow Jones really did, he created 2 indexes. He created the Dow Jones Industrial Average and he created the Dow Jones Transportation Index. And now he found relevance or correlation between these 2 indexes. Now, he found out that when the market is in uptrend, the Dow Jones Industrial Average was rising and the Dow Jones Transportation Index was also rising, right? So this is proper uptrend condition where both the indexes are rising. So until and unless this happens, the trend is good. But sometimes what he noticed was that the Dow Jones Industrial Average was rising, but there was some sort of divergence, or the Dow Jones Transportation Index started to diverge. It wasn't rising with the industrial index. Now, this was a warning sign. He considered this as a warning sign that the production that the industries are doing is not been distributed, is not been transported, because the earnings of the transport companies was not moving up with the earnings of the industries. So this was a red flag for the trend, and he concluded that when this type of divergences happen, the trend may come to an end. There may be a change in the trend. So what he concluded was that both the trends, right, both the directions, both the indices must move in the same direction to confirm a trend. So if there is a divergence, this is a signal of caution and there may be a potential reversal. Now, here we use the word potential reversal because as we move to the next tenet, we will see why we have used the word potential. So this is an example that if the industrials were making a new high, but the transportation index was not making a new high, it was a confirmation that there may be a reversal. So this is the scenario which it mentions. Now, during the 1900s, when Dow created this indices, the Dow Jones Industrial Average and Dow Jones Transportation Index, he was comparing these 2. But now we know that the markets have evolved, and with the advent of computers, more calculations can be done, more indices can be created and everything, right? The more comparisons can be done, better comparisons can be done. So nowadays what we do, we compare the small caps and large caps, or we will compare the Nasdaq or the Russell, or we compare the S&P 500 or the Russell. Because if we talk about Russell 2000, right, Russell 2000 is a broader index which has 2000 stocks. Now, if the markets are really strong, we expect all the stocks or maximum stocks to do better. We don't expect handful of stocks to do better, right? So nowadays what we do, we generally compare the small caps and mid caps, or we compare the S&P 500 with the Nasdaq, or we will compare Nasdaq with the Russell 2000 for this type of confirmation. So let us come to the chart immediately and let me show you something very interesting. Now this is the current scenario charts, what we can see. Now see what happened recently, right? So we have S&P 500 on the top and we have Russell 2000 in the lower panel. Now what we saw that S&P 500 made a higher high. That meant the large cap stocks in the US markets, they were doing good. There was demand in those stocks and the S&P 500 created a new high. But if we compare it with the Russell, now during the same time, what we saw that the Russell 2000 index, which is a broader index, which has more stocks in it, which covers a broader market, was creating a lower top. So what we saw was a clear divergence. That means when a handful of stocks are moving and when only a handful of stocks were driving the whole market, that means the money is not flowing evenly in the economy. There is a concentration of money flow into some stocks. So this is a red flag. Sooner or later, it will imply that the markets will collapse. There will be money extraction out of the larger cap stocks as well that we saw at this point. Now, this was the time where the Russell started to move down and we can see S&P followed it later. So, this was an indication, or rather this was an alert that we could have got when we were comparing these two indices. Now, this was again propagated by Dow Theory. Dow generally, as I told you, compared Dow Jones Industrial Average and Transport Index. Now Transport Index is no more relevant right now as it was in 1900. So we are comparing this bottom. Again, if you compare the Indian markets as well, right? Let us compare the Nifty here and let me compare the small cap 250 stocks. Now look at this. You will find a very similar type of formation here as well. Now look at this area where the Nifty is creating a new high, right? The Nifty is creating a new high. But what do you see when you compare the same time with the small cap index? It wasn't able to create a new high. It was into a distribution mode. Look at this. Now do you see that? It was into a distribution mode. We did accumulation distribution in the previous episode. Now this was telling us that even though money is flowing into the markets, it is very concentrated in a couple of stocks, in a handful of stocks. But the small caps, mid caps were not moving with the main index. So it was telling us that the money flow in the economy or the money flow in the stocks is not evenly distributed. Only handful of stocks are moving or only handful of stocks are bought. So this is a very important formation and this is a very important theory that was propagated in the Wall Street Journal by Dow and Company. So as I told you that this will form the base of intermarket analysis. So let us take an example of Nifty and gold. So we know that gold is considered as a safe haven, and whenever stock markets start to decline or whenever there is some sort of crisis in the economy, people will start dumping the stocks and they will start accumulating gold. Now look at these charts. What really happened here? That the stock markets were moving down. This is the chart of Nifty and it is moving down, creating lower tops and lower bottoms. Now at the same time, what we saw that the gold was into an uptrending move. It was creating a higher top and higher bottom. Now look at this transition. What really happened? From here, the Nifty bottomed out and started moving up, and gold, now you can see, has created a lower top. This means that the gold is trying to correct from here, right? We have a double top formation in gold and it is trying to correct here. So again, this is the application of Dow theory, but in a very different way. We are doing intermarket analysis using the Dow theory. The base was set by Dow. Now again, there are lots of relationships. There's a relationship between Nifty and a dollar index. There's a relationship between Nifty and other sectors. You can even compare two different sectors. You can even compare two different stocks from different sectors. You can even compare two different commodities. Like, so suppose I think that you very well know the relationship between crude oil and gold. Now this is interesting, right? Crude oil and gold. What relationship do you see here? We can see that the crude oil was into a downtrend. gold was into an uptrend. Now crude oil is trying to bottom out. It has formed a double bottom sort of pattern and trying to move up, and the gold has been forming a double top type of pattern. That is a topping pattern. This is the bottoming pattern. Now again, this base was set by Dow. Now, Dow theory is a very deep subject, and the practical applications are way beyond than what even you can think of. So that's why when we are training our mentees, when we are training traders, we go very deep into Dow theories, we go very deep into Wyckoff methods, we go very deep into demand supply, because these are the base. Strategies are the last thing that you need to learn. The indicators are the last thing that you need to learn. Your base should be to understand how the real market is working, how the price really works, how the sentiment really works, how the philosophy of the markets really work. Alright, so this is about the indexes must confirm each other. The next important tenet is the volume must confirm the trend. That means if the prices are moving high, the volume should be higher. So the price high and volume are supportive, then the trend is fixed. Okay, no problem. Now when the price is moving up and the volumes are not supporting the price, then the trend need caution. Now just think about it. Just pause the video and think about it. Volume is the driving factor. Volume is the driving factor. Volume is the fuel. So if the price is moving up and the volume is moving up, we know that the price is sprinting and it has a driving factor behind it, which is pushing the price to go up. Now price is moving and we see the driving factor decreasing. What does this mean? This means that at some point of time in the future, this thing will also move down, because now it doesn't have the support of the driving factor, that is the volume. Volume is not supporting right now. So when a trend is moving up, it should have higher volumes. It should be supported by volumes. At a point when the volumes are not supporting, there is a high chance that the trend may change. Again, when the trend is moving down, it should be supported by higher volumes. Volumes shows participation. So when the trend is moving up, volumes are higher, that means more people are participating to drive the price up. When the trend is moving down, the volumes are higher, that means more people are participating to drive the price down. Now think of a scenario that the prices are moving up, but the volumes are not supportive. That means though the price is moving up, but very few people are participating in that rally. What will happen to that rally? Eventually, it will cease to move up and there will be a trend change. Similarly, when the price is moving down and we see volumes with the downtrend, that means a lot of people are participating into the selling action. But at a point of time when the trend is about to change, when there is a exhaustion of trend, we will see that the volume starts falling with the fall in price. This indicates that sooner or later the sellers are going to dry out and the trend may change from down to up. So the volume analysis is very important. That's why whenever we talk about price action analysis, we are not analyzing price in isolation. We always do price and volume analysis. And this is what is called as VPA, volume price analysis, or whatever you can name it, anything, right? VSA, volume spread analysis. Now this is a more refined and an advanced version of what we have just discussed. But for your academics purpose, for the purpose of CMT Level 1, what we have discussed is enough. Now if you want to go more in depth, you have to start researching, you have to start reading more that is beyond your syllabus, right? So now let me show you the same thing on the charts and let us see how these things really work in the real time. So we are on the chart of the crude oil and we will see how these things really work. What we see here, we see that the trend is moving down, right? The prices are creating lower tops and lower bottom, lower tops and lower bottom. This is the classical definition of a downtrend. How a downtrend is defined? Downtrend is defined when the prices are creating lower tops and lower bottoms. How an uptrend is defined? Again, when the prices are creating higher tops and higher bottoms. So this is the definition of a downtrend and this is the definition of an uptrend. Now, what does this tenet say? That when the prices are moving down, all these legs that are in the direction of the trend must be accompanied with higher volumes. And all these pullbacks, that means secondary trend, the trend which are against the primary trend should have lower volumes. That means there are no participation. when the price is pulling up. There are no buyers showing up. So look at this chart. Look at the chart of crude oil right now. So what do we see? When the prices are moving down, we see volumes are showing up. That means more sellers are interested here. When the price pulled up, like we can see that there was a pullback type of rally at this point. There was a pullback type of rally at this point. There was a pullback type of rally at this point. Now compare the red bars and compare the green bars. What does the red bars tells us and what does the green bar tell us? Red bar is telling us that there is a lot of participation because red bars are greater than the green bars. So there is a lot of participation when the selling is taking place. People are shorting, people are exiting their longs. And when there is a pullback, we cannot see any participation because the green bars, you can see the size of the green bar are way lesser or way smaller than the red bars. Right? Look at this point. Look at this zone when the selling really was taking place. Look at the volume. It was increasing. Right? Now look at this pullback. Look at this pullback and look at the volumes during the pullback. They were decreasing. That means this pullback wasn't attracting any buyers. Now let us come to this point. Look at the green bars now. How the relationship of the red bars versus green bars are changing slowly. Like look at the relationship. How many green bars do you see during this pullback, during this formation? How many red bars do you see during this formation? The frequency of green bars in the volume panel is more. We can see larger green bars when we compare it to the red bars. That means the sellers are now not participating. They are not willing to short or they are not willing to sell, or maybe the sellers have dried up. And we see that now the buyers are participating. The buyers have taken hold of the whole game and now they are trying to buy, and that's why the prices are pushing higher. So this relationship of price and volume is a very, very important component of Dow theory. Dow said that when the prices are moving up, now at this point, you can see that the prices were moving up and we also had good volumes. You can see the correction, the secondary trend, and look at the volumes. Look at the volumes, no participation in the volumes. Again, when the prices started moving up, look at the volume started to pick up, right? Again, this is called an exhaustion volume. Now, this is beyond the scope of Dow theory. This is called exhaustion volume or the climax volume. And then the whole trend changes and we see the prices declining down with higher volumes. Now, the declines have higher volumes. So, this is what the Dow theory talks on the volume and the price analysis. That any trend which is moving up should be forced, should be backed by volumes. And if the price is moving up and the volumes are not there, then there is a high chance that the trend will change. Similarly, in the downtrend also. So, hope this is clear, right? Now, what you have to do, go on the charts and try to practice this. Now, if you practice these practically, when you will approach the questions in the exams, it will become very, very simple for you. So, when we appeared for the exam, we were already trading. We were already managing clients' funds. So, these things were not that tough for us to understand. Alright. So, let us go again to the final tenet, that is trend remains in effect until reversal. Now, this is a very, very important tenet. Now, this tenet tells you indirectly that stop predicting the price and focus on what the trend is telling you right now. Now, how the Dow really defined the uptrend? The uptrend is when the prices are creating higher tops and higher bottom. Now, very simple, keeping it very simple, when this series of higher tops and higher bottom changes to the series of lower tops and lower bottom, we have a change in the trend. As simple as that. This is what Dow theory says about the trend. Similarly, how Dow theory defined downtrend, when the prices are creating lower tops and lower bottoms and moving lower. And when this sequence of lower tops and lower bottom is broken and we get a sequence of higher top and higher bottom, we say that the trend is changed. So, until and unless we get proper confirmation of this transition from lower tops to lower bottom to higher tops to higher bottom, or from higher tops to higher bottom to lower tops to lower bottom. Now, look at this chart. Now, what is this? See, the prices are creating higher tops, higher bottom, higher tops, higher bottom, higher tops, higher bottom, higher tops, higher bottom, right? So, according to Dow, until and unless the price are creating higher tops and higher bottom, the trend is okay. We are not supposed to think anything other than this thing, that the trend is up. Now, once this sequence is broken, right, And now you can see that we have a sequence of lower tops and lower bottoms. Now when this sequence is broken, we can say that the trend has changed. Now what was the point of trend change? Now this level was the point of trend change when the last swing or the last support of the uptrend was broken. So this was the point where the trend actually changed. This is about support and resistance. And now look at this point, and now you try to practice this, that at which point on this chart the trend really changed. This was a sequence of lower tops and lower bottom, right? We got the first higher bottom here, and then this was an important point. This was the last high of the downtrend, and when this high was taken out, actually the trend really transited at this point. And now from here on, we are getting sequence of higher tops and higher bottoms. So until and unless this sequence is confirmed, the trend is said to be in effect. So trend continue until and unless there is a clear reversal. Now this is the clear reversal sign when the trend changes from lower top, lower bottom to higher tops, higher bottom. Reversal may be signaled by breaking previous trend highs, what just we have discussed. And this tenet discourages premature counter trend action. Very, very important. As a technical analyst, as a stock trader, you are not supposed to trade counter trend, because money is made only when you trade in the direction of the trend, not counter to it. If you really want to make your clients happy, today stand in front of the mirror and start repeating every day in the morning that you are not going to trade against the trend, and repeat it 5 times, and you will have happy clients. Or if you are trading for yourself, you will have a happy P&L account. So whenever you try to trade counter trend, the market will beat you up very, very badly. The objective is to remain in the trend as long as possible. And real money is made when you are trading with the trends, my friend, not against it. Alright. So all the 6 tenets are covered now, and we will come to the conclusion part where we will see the pros and cons, and we will see the ideal market picture as per Dow Theory. The bull market confirmed uptrend in both industrial and transportation index. Right, for us, we have seen S&P 500 or Russell, we have seen Nasdaq or Russell, we have seen Nifty and small cap, mid cap. Volume must be increasing with advancing price. So the price are moving up, the volume is also moving up, and when there is a divergence between price and volume, we may see correction. Trend is composed of higher highs and higher lows. We have discussed that when we are talking about uptrend, we need higher tops and higher bottom. When we are talking about downtrend, we need lower tops and lower bottom. All news are reflected in the price. Do not go washed away with the tweets, with the YouTube videos, with the television channels, right? Whatever you hear, whatever you read, whatever you see is already discounted in price. Each new high in one average should be confirmed by the other average. Again, intermarket analysis, very, very important. This is not intermarket analysis. Basically, this is intramarket analysis. But again, we have to see that there is an equal force, buying force or selling force in both the indexes. Reversals are the signals of a new primary trend. So until and unless we are getting trend reversal signals, we are not here to trade prematurely. So what are the strengths of the Dow theory? While I am very, very sure that the way I have explained the 6 tenets, you must have understood what are the strengths. I have gone little bit non-conventional way also, but again, we have to stay within the curriculum. So I have to stay within the books to explain you how the things are working. It provides clear guidelines for the trend. We have seen that there are proper guidelines: uptrend, higher tops, higher bottom; downtrends, lower top, lower bottoms; primary trend, secondary trend, minor trend. There are clear guidelines. Very, very important: discipline and confirmation. Again, I am telling you, this is one of your principle, golden rule of technical analysis, a golden rule of stock trading. Now, first golden rule is that never trade against the trend. For the first golden rule, right? And the second golden rule is always seek confirmation. Do not predict. Prediction is not our work. Prediction is done in astrology, not in stock markets, right? And form a basis of many modern indicators and strategies. It's very, very important. I told you that Dow theory is the base. We are talking about intermarket analysis nowadays. It's the base. and still relevant. I would say that if you ask me, price action, 90% of price action is about Dow theory if you can understand it properly. If you have learnt it from the incorrect source, of course application will be incorrect. There are some criticism, always people are there to criticize any good work, no doubt. They say signals lag and we may miss early part of the trend. What does it really mean at this point? Now just look at the chart. It means that where did we get a signal according to the Dow that the trend has changed? We got a signal somewhere here when a lower top was made. So what does this point say? That we have already missed this point, right? We have already missed this whole move when we got a signal, right? The signal was somewhere here. But if we refine our analysis and if we mix Wyckoff with Dow theory, then I think that we can time ourselves better. But I don't think that we get any signal lag in Dow theory, because if we apply all the 6 tenets properly, then there will be no lag. Now, if you compare it with the Russell, if you compare it with gold, if you compare it with the dollar index, you will get early signals that there is a divergence, right? If you use intermarket analysis, you won't get this lag. It does not address to short-term trading, and it says non-equity markets. I do not agree with this. It is applicable on every market. And short-term trading, of course, if we talk about Dow theory 100 years ago, then it wasn't fit for short-term trading. But now I think that you can apply it on any time frame. You have to adjust your primary trend, your secondary trend, or your minor trend accordingly. That means this can be on the weekly chart, this can be on the daily chart, and this can be on the hourly chart. Now, if you want to reduce the time frame, then you can do it. This can be daily, this can be hourly, and this can be 15 minutes. Now, if you want to reduce this further, use 15 minutes, 5 minutes, 3 minutes, right? Primary, secondary, and minor trend, whatever you can. It can be used on any time frame, but the text and criticism says so that it cannot be used in shorter time frames. And traditional averages may be outdated. Of course, it is outdated. That's why we have already catered to this criticism, that we are now approaching the Dow theory in a very, very fresh way. So these were the criticism that we saw. Now, everyone likes to criticize, right? We will have a lot of criticism on the comment section of this video as well. No issues. We have to move on and we have to do our work. But the thing is this, when you are getting the core of the thing, when you are understanding the value of the tool or value of the subject, and when you understand the value of this video, and if this video has helped you even 1% in your preparation, the criticism doesn't matter to me. Now, next is relevance of Dow theory, still used to access market conditions. As I told you that in my trading, I still use Dow theory, and Dow theory is the core of my technical analysis trading, my technical analysis reports, my technical analysis concepts. I teach my mentees about Dow theory. I teach my mentees about everything that is included in Dow theory. So Dow theory is the core, I would say, core of technical analysis, if you understand, because nowadays this is lost. People nowadays are like into instant gratification. They want quick profits, quick out, quick in, quick out, quick in, and that doesn't matter. Okay, you will be out of the market in just 1 or 2 years if you are pursuing this type of trading and this type of thing. Next is institutional investor monitored Dow confirmation. Now see, if institutions are doing this, are you smarter than the institutions? So always. Now, whatever we do, right, whatever we are doing, SMC, VPA, price action, everything, right, indicators, some trend following indicators, they all are based on the Dow theory. Dow theory nahi kiya, so you are finished. You won't be successful in this market, I'm telling you. Elgo pelgo, nothing will work, sir. You have to understand the core. And it remains the foundation of CMT curriculum and market philosophy, right? But CMT also talks about predictions. CMT also talks about predicting the market. When we talk about Elliott wave theory, we will see that Elliott wave theory is also based on Dow theory actually, because it also seeks confirmation, but it also have a predictive element in it, which I am against it. But many people are Elliott practitioners. They do very good in Elliott wave theory, right? So what are the Dow Theory Essentials? You have to understand the 6 tenets very, very properly. Volumes are used for the confirmation of trend. You have to recognize every phase of the market, primary phase, secondary phase, minor phase, to be in the right path, because these phases will guide your trading strategies. And as I told you, that Dow theory will guide you about market breadth also. So it will also help you in understanding the psychological components of the market. And Dow theory is not a trading system, but again, it is a psychology of market behavior. But again, I would disagree with it. Dow theory is a trading system, and plus, of course, it is a very, very important psychology of the market. So we can use Dow theory as a trading system, and also we can use it as a psychological tool, as a market breadth tool, as a price action tool, and everything else. Right. So with this, I end today's session, and you will get the MCQ link in the description. You can go and download the MCQ sheet, and you can practice those questions there. And I hope that this session was fruitful. And if you really liked it, do like the video, subscribe to the channel, and do share the video with your co-learners who are learning CMT or CFT or MFT or whatever it is, because it is helpful in every curriculum right now. So with that, I end today's session. We will again come back with the third chapter in the CMT curriculum very soon. Till then, keep earning, keep learning, keep sharing. Bye-bye.